Welcome back, everybody. It's good to have you. So we have currently two very hot topics that are on everybody's mind, and those are inflation and rising mortgage rates. You have probably seen this on the news that mortgage rates have been rising extremely fast over the last few weeks, and that is, of course, concerning to a lot of people because it makes the cost of borrowing money in order to buy a house more expensive. It's probably the number one discussion that I have currently with clients. They're wondering, where is the market going to go? Could rates really crash the spring market that we're embarking on currently? And what is going to happen? So I think this is a reasonable concern. When you look at everything, it kind of feels like it makes you a little bit nervous. But whenever you feel this way, then I always suggest let's look at the data, and that's what I want to do today. So the short answer is no, it does not look like the sky is falling as much as you might think it when you hear the news. And we see this on a daily basis. The long answer is a little bit more differentiated. We have to take a look at the data there. There's certainly an impact that higher mortgage interest rates are having on the housing market, and that's my topic for today. But before we go there, let's take a quick look and see what happened in March. So here we have the latest numbers straight out of MLS. I have here March 2022 single family sales compared to last year in March. And then below, you may notice I've simplified the layout a little bit. Below, we have just my 2015 comparison year as a benchmark. That was the last year where we had a normal balanced market. You can see inventory came up a tiny little bit, 8%. That was mostly in the last week of March. We've seen more listings come on the market. That has helped a little bit, but we're still a far cry from the 11,000 that we used to have in a normal year. So with that, we've sold about 1,900 single-family homes in Milwaukee, which is about the same as we used to. But here's the big difference. Only 6 days on market. So this is median cumulative days on market. That's a new metric I have here. And you can see the difference in the velocity, in the speed. Homes are selling typically on the first weekend. And of course, they're selling with multiple offers. 10 to 15 offers, sometimes over 20 is what we usually see. And so that, of course, is driving up the prices. So we're now at 10.2% over where we were last year in March. So sales were limited by the inventory, but in terms of competitiveness, the narrative was that maybe 2022 is going to be a little bit slower because 21 was crazy, and we're not seeing that. So if anything, it is even more competitive than it was last year, if that is possible. Multiple offers over asking is the norm. That's pretty much standard. We expect it. It's shocking if you call the listing agent and you find out there is no offers on a property. There's usually something wrong with it. And we had a really good month in March. We had 17 closings. That's between me and my team. And that was a lot of hard work. The reason why I'm telling you this is because we had to write well over 50 offers to get to 17 transactions. There's also some listings in there. But what this does, it gives us a lot of data points. We are seeing what offers are getting accepted, what offers are not getting accepted, how are offers coming in on average. And we are having a meeting every week where we discuss our experience, how did it go with offers. And those are very valuable data points for everybody on the team to know what you have to write in a current market to get an offer accepted. So that is an unfair advantage that we have for our clients because we can anticipate what typical offers are going to look like. I cannot predict outliers, so there's always a little bit of uncertainty. If somebody really wants a house and goes above and beyond, you can't predict it. But because we're doing enough volume, we can see what is typically necessary for an offer to stick. Now, the big question is what is going to happen with the market in the face of rising mortgage rates? And this is what I want to take a look at and some data here today. All right, before we go into mortgage rates, for some context, let's take a quick look at inflation. Earlier this week, we got the latest numbers from the US Consumer Price Index. Inflation is now at 8.55%. And a lot of people are thinking about this a little bit the wrong way because they're thinking of inflation as prices for gas, for groceries, and for other things are going up, right? Because that's what they're seeing in the news. What inflation really is, at least for the most part, is that the purchasing power of the dollar is going down. So if you would have bought a particular product a year ago for $100 and you ordered it again today, you would have to bring $108.55 on average to buy the exact same product. So the purchase power of the dollar is going down. And when you finish that thought, that also means that when inflation is coming down, and eventually it will because the Fed is managing towards that, when it comes down to 2 or 3%, that does not mean that prices are coming back down to what they used to be before inflation. That just means that prices are not going to further increase. Let that sink in for a minute. A lot of people, I think, are still expecting that once inflation is over, prices are coming back down again. We will see that here and there. But by and large, that means when inflation is coming back down to 2%, that means that price increases are slowing down. It does not mean that we're going back to prices we have seen pre-inflation. Okay, so this is also true for the real estate market. If you would have bought a house a year ago for $100,000 and now you have to pay $110,000 for it because you've just seen the Milwaukee numbers, that means you need to bring $10,000 more to buy the same house. And net of inflation, the home value increase was only 2 or 3%. So that is actually very much in line with long-standing historic averages when you factor out inflation of the home price increases. So the other thing that I think is important is that the Fed has been talking the longest time from this is only transitionary, this is only temporary. When you look at the history, and you have to go back a little bit to the 70s and 80s to see these nice peaks, it took 2 to 3 years for that to ramp up and then another few years to come down. And even in more recent scenarios, it always took a while for things to change. So I don't think it is a very realistic expectation to think that inflation will end next week. I think we will have to deal for this with quite a while. It's going to be a question when we're actually reaching the maximum peak, and then we can start the journey back down. So what is the Fed doing to curb inflation? They are hiking interest rates, and while they have no direct control over mortgage rates, of course, there's an indirect effect, and we have seen mortgage rates going up quite dramatically. You can see here the blue line is the 30-year fixed, and it really has shot up, and it's now at 5%, theoretically at least, if you have perfect credit. And hold that thought, because I'm going to get back to this in just a little bit. Now, the reason why this increase looks so dramatic is because over the last 2 years, we've gotten used to mortgage rates usually in the low 3% range. That has been very, very common, but you only have to go back to November of 18 and you can see that we were at 5% at that time. But back then it felt, relatively normal. And if we zoom out a little further, you can see here all the way going back to the 1980s, we had here 18% mortgage rates. Then in the 90s, we were between 6 and 8%. In the 2000s until 2010, we were between 5 and 6.5%. And then over the last 10 years, we're averaging about 4.5%. So this puts the latest increase a little bit in perspective. So I guess the big question is what's going to happen next. And here is a guy who should know from Freddie Mac. He's the chief economist. In case you didn't notice, Freddie Mac is the government-sponsored enterprise that is buying up all these 30-year fixed-rate mortgages from your local bank. So your local bank can keep issuing them. So if anybody, he should know, I guess. And he's saying mortgage rates are likely to continue to move higher throughout the balance of this year, 2022, and also 2023. But he's saying that the increase that we've seen so far should have been the steepest because the new change in the Fed's monetary policy is already priced in, and the increases that we are going to see from now on should be slower. Well, hopefully he's right. We'll definitely keep watching it because that has a major impact on the market. Now, I mentioned before that the rates that Freddie Mac has are somewhat theoretical, and a good resource that you can use are actually Google rates. So if you Google mortgage rates, you will come to this page here where you have rates. You also have a very handy calculator here. And you can see in Wisconsin, a $300,000 loan with 20% down and a kind of average credit score of 720 to 739 will give you a 30-year fixed rate on average of 5.46%. So you have to have a perfect 800-something credit score in order to get that 5% rate. If your credit score is a little bit lower, you can easily be at 5.5 or even 6%. And this is what we're seeing very common in the marketplace in the last couple of weeks. So now that we've seen what mortgage rates are, what is the real life impact to buyers? And I've done some math here with rates going up from 3.75 to 5% on different loan amounts. You can see here 250,000 borrowed, 350,000 borrowed, or a jumbo loan 640,000. So you can see the impact here is $184, 258, or 472, which is, compared to that size house, a relative modest amount. So I think this is the reason why we have not seen a lot of buyers disappear from the market. I have not gotten a comment from a single client of ours that they said, hey, rates have gone up, we're out of the market. I think once a family has made the decision to buy a home, they are going to follow through with that, and they're finding a way to either come up with an extra $200 or $300, or they are going to shop in a neighborhood that is just a little bit lower priced, but they are usually not going to abandon their home buying plans. So of course this has an impact on affordability, how much people can afford or how much they have to budget for housing every month. But from everything that we've seen so far, both in the data and what I'm experiencing every day in my work, is we have not really seen a change and impact on the marketplace, because there's just so many buyers out there that the dynamic in the market has not really shifted because of the interest rate changes as of yet. We will continue to keep an eye on that. And it depends, of course, what rates are going to be doing from here. In order to get a better understanding of what the impact could be, it's interesting to look back in history. And I got a rather complicated looking chart here for you, but no worries, I'll walk you through. So these are periods of time when interest rates have been rising, and usually they've been rising for about a year and a half, on average about 13 months, and they increased on average about 1.5%. And the question is, what did this do for home prices and for the home sales volume? So you can see here it varied from time period to time period, but in all of them, prices went either, well, that's basically sideways, but here we had some good increases. On average, we have seen plus 8% over those same time periods. And when you look at home sales, sometimes the market was a little bit suppressed here in the 90s on a very high interest rate level. I think we were at around 10% mortgage rates back then. The market went down in volume by around 11%, but prices did not really get pushed down. Prices are downward sticky. They're just holding the price. If sellers don't have to sell, they're just not going to sell, and they're holding their price. But on average, you can see minus 5% on volume and plus 8% on home prices. I mentioned earlier that we had a lot of forecasts that were predicting that 2022 would be a little bit of a slower version, a little bit more of a muted version of 2021 that does not line up with my everyday experience here in Milwaukee. It does also not line up with the research data that I'm seeing. And here you have a statement from Lance Lambert. He's with Fortune, and he says more industry insiders are throwing out their previous forecasts and replacing them with some more bullish short-term outlooks. Indeed, some experts say that 2022 spring housing market might go down as one of the most competitive on record. This is certainly what I'm seeing here currently in Milwaukee. So how is this possible, you might be asking? We have home prices going up, we have rates going up, affordability is going down, and the market is still going crazy. Well, it comes down to basically supply and demand. It comes down to the simple fact that we have currently more people in the US than we have houses to go around. And how did we get to that situation? Very simple. I can explain it in two charts. So here you have single family housing units completed, and there is an average for the last 50 years. And you can see we have started in the 90s to overbuild, and we had an exuberance here, which actually led us up to having way too many houses, and then the subprime mortgage crisis and the market crashed, and a lot of the builders went out of business and they stopped building new houses. So this led us to 14 years, the last 14 years, we have underbuilt the market. So there is that huge gap of homes that we have not built, that slowly year after year has been piling up to a bigger and bigger housing deficit. And depending on which economist you believe, it is going to take us about 8 to 10 years before we're able to catch up and build enough houses to fill this void here. Well, it took us 14 years to create it. So it will be a few years before we can fill it. Now, the second thing here is that we have seen a shift in demographics. Millennials have changed from staying at home or renting to we want to buy a home. And why is this happening? The oldest millennials are now turning 40, so they're most likely getting married, having babies. And so now it's time to buy a house. They're also seeing rent prices going up year after year. And once they have decided to buy a house, they're usually not going back on their resolve. It doesn't matter what the interest rates are at that point. That's just background noise. they have decided they're ready to buy a house and they're going to do it. Just look around and look at your friends. If anybody has decided to buy a home, there's very, very few that will go back on that and will say, oh, never mind, we'll just move in with the parents again. So this, of course, creates a problem because we have underbuilt for 14 years. We don't have enough supply. The US population has increased also over the last 20 years. And this is what is getting us in this situation where we are right now. Just for reference, in Milwaukee, we have about 300,000 millennials. So if all of them get married, that's 150,000 couples that are trying to buy a home in the next few years in a market that is about 10,000 units a year. How is that going to work? So what can we expect if they're all following through? Here I have some data from the latest home price expectation survey. So these are 100 real estate experts. They are either economists, they're working for research companies like Altus Research or CoreLogic, or they work for major financial institutions. And once a quarter, 100 of them get surveyed to say what they're expecting for the next 5 years. And here's what they're thinking. So if you would buy a house this year for $360,000, they're expecting it to grow in value to $456,342. So that's an increase of a little over $96,000. So when you're thinking now, great, we're all going to get rich, here's the caveat. This is all measured in today's dollars. So you have to think again in the context of inflation. If inflation stays relatively high, this is in today's dollars, that means these $96,000 are not going to be worth as much as they are going to be worth today. So that's why you want to take this with a little bit of a grain of salt. So if we're not making $96,000, at least this goes to show that real estate is a really good hedge against inflation. And that is also supported by the data that I have here from CoreLogic. This shows the inflation rate over the last 50 years in comparison with the home price appreciation. And what you can see here is that home prices have kept up really well with inflation rate, if not even exceeded inflation rate, and have been therefore a really good hedge against inflation. Now, Altus Research is one of the big data crunchers that we have in the US. They specialize in real estate data, and they're one of the big research providers. And they came out with a statement last week where they said, we keep watching for it, but there are absolutely no signs of a market slowdown anywhere in the data. If anything, we're seeing the market to continue to heat up. So this is also basically what I see here in the Milwaukee market, what I've seen over the last few weeks. I'll keep looking for how many people are attending showings and how many offers are going to be written, and I'll let you know when we see any signs of a slowdown. But at the moment, I'm not seeing it in the data. I'm not seeing it in my daily work. On that note, I have more information to share, but I know you're busy. And even though YouTube is incentivizing me to make longer videos, I want to be respectful of your time and keep this as short as possible. So if you appreciate that, then please give this video a thumbs up. That would be great for my channel to reach more people in the Milwaukee area. And speaking of Milwaukee, let's take a look what we have in the crystal ball. So a little bit of good news with inventory. We're expecting more listings to hit the MLS in the next few weeks. And there's basically two reasons for that. Number one, April, and we know this from historic data, April is traditionally the single best month to put your house on the market if you want to net the most amount of money. The second reason has to do with higher mortgage rate and the impact that has on sellers. So far sellers have been incentivized to not put the house on the market because the longer they waited, the more valuable the house would become, and interest rates were very low anyways, so there was no incentive for them to put the house on the market. Now things are changing, mortgage rates are going up, and most sellers are also buyers. Either they're upgrading to a bigger home or they're downsizing to something smaller. They also have to buy something, and if they're using a mortgage for doing that, they're thinking now, if I want to make a move, I'd rather make the move now so I can buy my new property with a lower interest rate before rates are continuing to go up further. So those are the two reasons why I think we're going to see more inventory coming up. Rates are most likely to continue to rise, but as we've heard, on a slower pace than what we've seen so far, but they should be rising throughout the rest of the year. At least that's currently the expectations. And higher rates will mostly impact first-time homebuyers because that's the buyer group that has the least amount of disposable income. They're usually on the smallest budget, and for them it will be the toughest to begin with. But overall, there's so many buyers in the market that the market will remain extremely competitive over the next few weeks. So if you're thinking of making a move this year and you've been contemplating, but you're not sure how to do this and you need good guidance on that, you have my contact information here on the screen. A lot of people are sending me an email after they've seen some of my videos. If you want to, we can hop on a Zoom call as well or on a phone call and discuss your individual situation, because I can tell you everybody's situation is so different and there's so many things to consider that it's hard to give really a one-size-fits-all type of advice here. And yeah, that's basically all I had for you this month. Thank you very much for watching, and I'll see you at the next one.